You can calculate a caregiving budget correctly and still miss part of its retirement cost. Suppose a 50-year-old worker has $11,200 a year going into retirement, including an employer match. If caregiving takes that worker out of the job for 5 years, $56,000 of contributions never happen. But that is only the visible loss. If those missed contributions had remained invested until age 65, the modeled gap is about $89,800 at 4% annual growth, $100,800 at 5%, and $126,700 at 7%. So the Care Bill has a second ledger, what today's decision can remove from retirement later, and the retirement account is only the first place to look. This is not a fringe problem. AARP and the National Alliance for Caregiving reported in July 2026 that more than 51 million Americans were caring for someone age 50 or older. On average, those caregivers had already been providing care for 5 years and were spending about 26 hours a week doing it. In the broader 2025 National Caregiver Study, 31% said they had stopped saving, 13% had used long-term savings, such as retirement or education accounts, and 23% said they had taken on more debt while caregiving. Those are self-reported financial impacts, not proof that every caregiver will experience them. But they establish something important. Caregiving is already showing up in savings, debt, and work decisions for millions of families. The first ledger is obvious. What does care cost right now? CareScout's 2025 national medians were $35 an hour for a non-medical caregiver, $6,200 a month for assisted living, and $9,581 a month for a semi-private nursing home room. Those are national medians, not quotes for your family, and actual costs vary by location and level of care. But they make the pressure behind these decisions easy to understand. One caution before comparing those prices. The units are not interchangeable. The $35 figure is hourly. The assisted living and nursing home figures are monthly. CareScout's annual home care illustration assumes 44 hours a week, while an assisted living monthly fee can bundle housing and services that an hourly home care rate does not. So a family cannot honestly look at $35 versus $6,200 and declare one option cheaper without first defining how many hours of help are needed and what costs are included. The visible caregiving ledger needs clean units before we even get to retirement. There is another reason the immediate bill can dominate the conversation. Families may expect health coverage to absorb more long-term care than Medicare actually covers. Medicare can cover qualifying skilled nursing care for a limited time when its conditions are met, but it distinguishes that from long-term custodial care, including help with activities such as bathing, dressing, and eating. Medicare generally does not pay for that long-term custodial care. Once that gap becomes real, the family question can change quickly from "what will insurance pay?" to "how do we absorb this?" That answer can affect work hours. It can affect whether retirement contributions continue. It can create pressure to use savings that were meant for much later. And for some workers, it can make a hardship distribution look like the cleanest available bridge between an immediate care bill and money sitting in a retirement account. None of those choices is automatically irrational. Immediate liquidity has value. Time with a parent has value. Keeping a job has value. Avoiding institutional care can have value. The analytical mistake is giving one side of the decision a dollar amount while leaving the other side unpriced. Maybe one adult child cuts work hours. Maybe someone leaves work completely. Maybe the family uses cash savings. Maybe they look at a 401k and think, the money is already there, the need is immediate, so this solves the problem. Each option solves something real. Each can also move part of the cost out of the caregiving budget and into retirement. Start with the cleanest piece of math, contributions that never happen. Keep the same hypothetical worker. Total annual employee contributions plus employer match, $11,200. Assume 5 annual contributions are missed from age 50 through age 54. Hold that annual contribution amount constant so the example stays transparent. Do not treat the growth rates as forecasts. 5 missed deposits mean $56,000 of principal never enters the account. If you stop the calculation there, you miss the time attached to those dollars. Under a 4% annual growth scenario, the age 65 difference is about $89,800. At 5%, about $100,800. At 7%, about $126,700. Those are modeled scenarios, not promised returns. Markets do not produce a smooth annual path, and the example is not adjusted to predict future inflation, wages, or contribution limits. It isolates one mechanism. Contributions that never enter the account also lose every year of growth they otherwise could have received. An employer match can make that effect larger because leaving the job may remove money that was not coming from the worker's paycheck in the first place. That is the first retirement cost a caregiving budget can miss. And notice why it is easy to overlook. A $6,200 assisted living payment is a visible transaction. A contribution that never happens creates no charge on a bank statement. The evidence appears later as a retirement balance that may be lower than it otherwise would have been. The relevant comparison may therefore extend beyond salary versus care cost. Total compensation can include retirement contributions, health benefits, paid leave, and other employer benefits. Which pieces disappear depends on the employer and the worker, so there is no honest national formula that converts leaving work into one universal retirement loss number. Duration matters too. At the same 5% growth assumption, missing only one $11,200 contribution at age 50 produces a modeled age 65 gap of about $22,200. Missing 3 annual contributions produces about $63,400. Missing 5 produces about $100,800. The relationship is not just 5 times 1 year's contribution, because each missed deposit loses a different amount of time in the market. That is why a caregiving plan expected to last 6 months and one expected to last 5 years should not be treated as the same retirement problem. The useful part of the example is the method, not the $126,700 headline. The inputs are the annual contribution and match, the number of missed years, the time remaining until retirement, and a range of growth assumptions. But retirement accounts are only one clock. Social Security uses another. You may have heard a simplified claim that leaving work for 5 years means Social Security inserts 5 zeros into your record. That can happen. It is not automatic. Social Security bases retirement benefits on the highest 35 years of indexed earnings. If you ultimately have fewer than 35 years of earnings, years without earnings are included as zeros in that 35-year calculation. If you already have 35 years, however, another year away from work does not automatically create a zero. The cost may instead be that a later higher earning year never arrives to replace an older lower earning year. A 50-year-old with 27 earnings years therefore faces a different Social Security exposure from a worker who already has 36 strong earnings years. Same caregiving interruption, different mechanism. That is why attaching one universal Social Security dollar loss to 5 caregiving years is not defensible. The formula introduces another complication. Social Security's bend points depend on the year a worker first becomes eligible for retirement benefits, generally the year the worker turns 62. The 2026 bend points apply to workers becoming eligible in 2026. They are not the future bend points for a hypothetical 50-year-old in 2026 who will turn 62 in 2038. So the conclusion has to stay conditional. Caregiving can change the earnings record Social Security eventually uses. The size of the effect depends on how many earnings years the worker already has, the earnings levels in those years, what later earnings would have replaced, and the benefit formula that applies when the worker becomes eligible. Two caregivers with the same current salary and the same 5-year interruption can therefore finish with very different retirement effects. One may be adding zeros. Another may simply fail to replace low-earning years. One may lose a large employer match. Another may have no match at all. The retirement cost has changed again. It is no longer only an account balance. It may also involve the earnings history behind a future Social Security benefit. Now, take the obvious countermeasure. Suppose the caregiver stays employed, keeps the paycheck, keeps contributing, keeps adding earnings to the Social Security record, and uses retirement money only to pay the care bill. That seems to protect the first two parts of the retirement ledger. But access to retirement money and the tax treatment of that money are separate questions. A 401k plan may permit hardship distributions for certain immediate and heavy financial needs, including certain medical expenses. The plan allowing a distribution does not make the distribution automatically tax-free, and it does not automatically remove the additional tax that can apply to an early distribution. For a traditional pre-tax 401k, a hardship distribution is generally included in income. If the worker is under 59.5, the taxable portion may also face an additional 10% tax unless an exception applies. One exception involves unreimbursed medical expenses. The amount covered by that exception is tied to qualifying medical expenses above 7.5% of adjusted gross income for the year. Now, use a deliberately simplified example. Assume our worker is under 59.5, has $80,000 of adjusted gross income before the distribution, takes a fully taxable $20,000 distribution from a traditional pre-tax 401k, pays $20,000 of otherwise qualifying unreimbursed medical expenses during the year, satisfies the relevant dependency rules, and has no other exception available. The taxable distribution raises adjusted gross income in this illustration from $80,000 to $100,000. 7.5% of $100,000 is $7,500. Subtract that threshold from the $20,000 of qualifying medical expenses, and $12,500 remains above the threshold. Under these assumptions, about $12,500 of the early distribution fits this medical expense exception. About $7,500 does not. 10% of that $7,500 is $750 of additional tax, assuming no other exception applies. The important part is not the $750. It is what changed the calculation. The taxable withdrawal helped raise the adjusted gross income used to set the 7.5% threshold. Change the account type, age, income, expense amount, taxability of the distribution, or available exceptions, and the result can change. The example proves a mechanism under stated assumptions. It does not produce a universal penalty for caregiving withdrawals. It also shows why hardship is an access label, not a complete tax answer. And even the medical expense calculation has another condition: whose medical expenses qualify. If you pay medical expenses for a parent, dependency and support rules matter. The general qualifying relative framework includes support requirements, but the rule is not always as simple as one child personally paying more than half. IRS rules also recognize multiple support agreements in qualifying situations where several people collectively provide more than half of a person's support, and no one person provides more than half alone. So there is no honest one-line tax rule for every caregiving family. The result can depend on who paid the expenses, whose expenses qualify, the family's support arrangement, adjusted gross income, the kind of retirement money withdrawn, the worker's age, and whether another exception applies. That may be less dramatic than saying the IRS takes some giant fixed percentage. It is much harder to misunderstand. Now step back from the tax calculation. The larger story is that caregiving crosses systems that operate on different timelines. Care costs can arrive this month. An employer plan records whether contributions happen this year. Social Security builds an earnings record across decades. The IRS looks at the year a distribution and qualifying expenses occur. Compounding changes with the amount of time left. A family can solve an immediate cash problem and still alter one or more of those longer-term systems. That is why which option is cheaper is incomplete until you define both the period and the unit. Cheaper this month? Less lost income this year? Higher retirement balance at 65, a stronger Social Security earnings record? Less tax triggered by accessing retirement money? Those are different questions. And the analysis has to survive the strongest objection. Some households do not have two financially attractive choices. Professional care may cost more than the worker earns. Local services may be unavailable. A parent may need supervision that the family cannot piece together around a normal work schedule. Paid leave may be unavailable. Liquid savings may already be gone. In those cases, the decision can be between painful options rather than between an obvious financial winner and loser. Independent government research has also cautioned against assuming that every observed employment difference among caregivers was caused by caregiving itself. Caregiving can reduce work for some people, but people with weaker labor force attachment may also be more likely to become caregivers. That is another reason this framework should calculate the consequences of a specific decision rather than pretend one national statistic predicts every household. Other conditions can change the outcome too. Some caregivers have access to paid family care programs, Medicaid-funded arrangements, VA-related support, employer benefits, or state and local assistance. Some workers already have more than 35 strong Social Security earnings years. Someone over 59 and a half faces different early distribution rules from a 50-year-old. Roth money can have different tax treatment from pre-tax money. A multiple support agreement can change how a parent's medical expenses are treated. So the point is not to rank caregiving choices. This is also where opportunity cost symmetry matters. Paid care has an obvious invoice, but leaving work has costs that are partly invisible. The reverse is true too. Staying employed can require paying for care that would otherwise be provided by family. A fair comparison cannot count the facility bill on one side while pretending the caregiver's time, lost compensation, and retirement effects are free on the other. It also cannot count every foregone dollar of salary as a pure loss while ignoring the paid care expense that employment may require. The comparison has to use the same horizon and the same categories on both sides. It is to make sure the comparison contains both ledgers. The first is care today, professional care, transportation, home modifications, medical expenses, unpaid time, reduced work hours, and lost wages. The second is retirement later, contributions and employer match that may stop, the growth those contributions could have earned, possible changes to the Social Security earnings record, and the tax consequences of retirement money used before retirement. Then test the conditions that can reverse the result. How many Social Security earnings years are already on the record? What kind of retirement money would be withdrawn? Is the worker under 59 and a half? Do the medical expenses actually qualify? What support rules apply? Does the employer provide leave or caregiving benefits? Does the family have access to public programs or paid care options that change the cash comparison? And before treating the result as an optimization problem, ask whether the family actually has more than one feasible option. If the answer is no, the calculation still matters, but its purpose changes. It becomes a way to see the financial consequences early enough to identify which benefits, family cost sharing arrangements, workplace options, or tax and legal rules might change the constraint. That does not make caregiving cold. Families make these decisions while trying to protect someone they love, often under time pressure. That is exactly why one visible number can feel like the whole answer. The caregiving bill is real. It just may not be the only bill created by the decision. One ledger is paid in cash and time now. The other can appear years later in contributions that never happened, growth that never had time to occur, an earnings record that developed differently, or retirement money that came out under rules more complicated than the word hardship suggested. Before calling one caregiving option cheaper, count both ledgers using the same horizon, assumptions, and units on each side.